Welcome to The Riff, where writer and investor Bern Hobart and I discuss the major inflection points caused by technological change. Our weekly conversation covers the obvious and not so obvious ways in which markets and businesses will adapt as a result. Let's jump right in.
So, Bern, I want to talk about your book again, Boom, which is out and which people should go pre-order. Almost out.
Almost out. It's 1 week from the day on which we're recording this. It is available November 19th.
Yes. So people should pre-order it or order it as soon as they can. And you wrote this piece about rehabilitating bubbles. So why don't you talk about what exactly you're trying to rebrand the concept of bubbles around? How do people think about it now, and how should people be thinking?
Yeah, so there is this kind of classic argument that bubbles are good because they create a lot of infrastructure, and even if they create too much for now, we do eventually use it. And there are lots of examples of that. Like, that is an absolutely true statement. Like, the US still has a really good freight railroad network, so it's actually very, very cheap to move products, like move large, bulky products within the US. And it is because we dramatically overinvested in that sector in the late 19th century. Great Britain also has a pretty good railroad network, and it is also the long-term result of having overinvested a couple decades earlier. And when you look more recently, something like YouTube is it's hard to imagine that business having very good economics if there hadn't been excessive investment in telecom infrastructure in the 90s. So like there are a lot of examples of that. But when you think about that, it is true that bubbles build a bunch of that infrastructure. But if that's the case for bubbles, then it is sort of like it's investments that would already been made, just they get made a little bit sooner. And if they get made before there's a real return behind them, then we probably would have been better off deferring that investment and just building that stuff a little bit later when there was more demand and when it was more certain. So what I think is special about bubbles is they cause things to be built where it's not like it would have gotten built anyway just a few years later. It would never have gotten built unless people were wildly, almost delusionally optimistic that they would find a market, they would find it fast, that if they didn't find it right away, there would be plenty of capital so they'd be able to survive, that if investing X amount of money in this project didn't lead to something viable that customers want, well, let's try investing 10X instead and see where that gets us. And that kind of thinking can lead to a lot of waste. And it kind of has to. Like they can't go on forever. There has to be a point at which we are so far ahead of real world demand, or where we've pushed some technology so far past its original limits that the next dollar just doesn't do very much for anybody. And that is the point at which bubbles collapse, when the bubble bursts. But that's also the point where a lot of people make up their minds about it. So people were talking about .coms for a lot of the 90s. I think from pretty much the Netscape IPO through the crash, it was a topic of conversation, but the peak of interest was around the peak of valuation and the peak of volatility afterwards when things were declining. And so that's when a lot of people form their opinions about these bubbles. Like they form them when everyone's talking, and like the crazier you are, the more money you've made. And then they kind of update those opinions either because they're vindicated or because they were wrong. When bubble bursts, some of those people went from billionaire to bankrupt in a very short time period. Some of them go to jail. And then you end up thinking about it less. And what seems to happen is that we all have this sense, and it's just a natural sense to have, that economic growth, that progress is sort of this natural thing that's always happening. And it is constantly happening incrementally in lots of spaces that you don't really pay attention to. There are just lots of little efficiencies, like planes get more and more fuel efficient over time and more reliable over time. And like the canned soda, the can needs less and less material over time. Like all of that stuff is getting continuously optimized, and you can sort of take it as a good working assumption that the products that you buy will, if not get better, they may get cheaper. It may be that you're an early adopter of a product and the mass market version of it is actually lower quality than the version that you're used to. But that doesn't mean that product is in more people's hands. So it's probably net good, even if the thing that's salient for you is you used to be able to get a better version of this and now you can't get it anywhere. So I think it's easy to overlook how much of that is caused by the after effects of these bubbles, and specifically caused by these one-off investments that really don't make sense unless everyone else is also making like the one-time investment. We have to capture this market. Like, this is our one chance to deploy capital to build out a competitive moat, and that moat will survive. But if we try to build it later on, it just won't exist. So someone like Amazon, like they were even very early on, they had this distinct vision that they were not just going to be this passive marketplace that was connecting buyers and sellers and then just, washing their hands of the transaction. Like, they felt like that was the easy, obvious thing to do, and that was a good starting point. But the more control they had over the full process, the more likely it was that they could actually set some standard for how good is it, like how good a decision is it to buy something online rather than in person. And that the more control they had over that process, the more they could find cases where it was just a strictly better shopping experience to buy online rather than in person. And for books, maybe not for bestsellers, but for books that are outside of the bestseller list, it was from the beginning better to shop on Amazon than to shop at a bookstore if you knew what you were looking for. And if you had a vague idea of what you're looking for, Amazon was still a good place to shop because they had reviews. You could find books by genre. You could find things in some author's back catalog that you didn't know existed. And you could also find related books. So books were like a really, really obvious case. And then there were a lot of other cases where there was skepticism that this would ever move online. So like clothing, for a long time, the question was, why would you buy something without having a chance to try it on? And there were a couple things that solved for that. One of which was people got used to, and then e-commerce sellers got built it into their model that there will be pretty high returns, sometimes like astonishingly high returns. And that is just a cost that you bake into your model. But also the cost of clothes went down massively. And when they get cheaper, it is easier to just, buy 5 variants on something, keep 2 of them, return 3 of them. You got what you wanted and you didn't have to actually leave your house to get it. And meanwhile, the store that sold them to you, like, it did lose some margin on the returns, but it did make a margin. It did make some margin overall. And if that store is Amazon, then they also have this flywheel of they're always collecting new data on your preferences. And every purchase that you make is one more reason to keep using Prime. When you're using Prime, that is one more excuse for Amazon to add something to the bundle, tell you about it, and give you yet another reason to stick around with Prime. So like they had this distinct vision, but it did rely on them actually making a lot of pretty expensive investments. Like they had to start building fulfillment centers pretty early on. That was extra expensive in the early days of Amazon because the sales tax, they didn't have to charge a sales tax because they were headquartered in a non-sales tax state. And anytime that they created a fulfillment center somewhere, they actually had a nexus there. So they did have to pay sales taxes. So there was like a little bit of a deadweight loss where they actually somewhat underbuilt relative to how they would have built in a different tax situation, but they still in some ways overbuilt. Like they did actually have to pare back some of those expansion plans after the bubble burst, after they didn't have an infinite supply of capital, but they'd already made enough of this investment that people got used to the idea that you shop on Amazon, you get the stuff you're able to find the stuff you wanted, and it's reasonably priced, and it gets there when they say it gets there. And then Amazon could just keep on improving that experience over time. Once they've made that initial investment, they could take the shipping time from like a range, maybe it's 10 to 14 days. They can shrink that range down. Maybe now it's 5 to 7. They eventually can pick a number like it's 2 days. And then once they have enough volume moving through that system, they can say, it's 2 days and it's free, but you do sign up for this membership program to get that. So like all of that stuff is built off of this foundation that got built one time because every time Amazon had spent another couple $100 million selling books at a very low margin, they could go to the market, they could issue more equity, they could issue more convertible bonds or borrow more money elsewhere and continue doing that. So that I think is just a qualitative difference between bubbles are just a way to pull forward some investment versus bubbles are a way to make investments that would otherwise not be made. And one reason I wrote about that was that the book is about to come out, and I think it's always good to have like some publicly available summary of the book, and reviews have started coming out, and I've been very, very pleased with those so far. But I also wrote about that because there were some stories coming out over the weekend in the information about AI, and in particular that the newest version, the newest major model that OpenAI is training, it is better than GPT-4, but they were kind of hoping for a similar gap as the gap between GPT-3 and GPT-4, and they're not there yet. And there are some concerns that it's just they've run into a data wall, like they've ingested all of the coherent tokens that have new unique insights, and so their model is as good as it can be at guessing that next token. And maybe there are little incremental improvements. Maybe there's still a lot to do once the general model has been trained. But yeah, maybe those scaling laws, they look like very straight lines when you graph them on a log chart, but maybe there is some bend in the curve at some point, and maybe we do run into some fundamental constraint, which happens in a lot of other technology bubbles. Like, you do just run into limitations where there's some axis along which you were expecting indefinite improvement, and you got improvement for a while, and then it stopped improving. Like this happened with oil in the US, where for a long time the US was the world's swing producer of oil. We actually had too much of it. We actually had to restrict oil production. And slowly those restrictions were loosened and loosened and loosened until the late 1960s, when all of those restrictions were eliminated. All producers could just produce flat out. They were not producing as much. They were producing a little less oil shortly after that than they had before that, and U.S. oil production declined for a long time after that point, with a couple positive oils after big discoveries, but mostly it was a decline after that until the rise of fracking. So that was a case where if you were analyzing the macroeconomy and just thinking of like, what are your broad assumptions, in the same way that today we have these broad assumptions of like the economy grows, per capita, like total factor productivity grows a little bit, and GDP growth includes some population growth, that the US is a bit younger than other countries and has a bigger tech sector, et cetera. Like, you have all of these things that are just like generalizations that you have to have in your head to understand the global economy. And one of the generalizations you would have in your head circa like 1970 was US economy uses a lot of oil, uses a growing amount of oil, but we can produce roughly as much as we need. Maybe we import a little bit, maybe we do, but that doesn't necessarily have to be the case. And anyway, it's fine. And oil prices are just like this very stable input into the model. Oil prices barely fluctuated at all for a period of like a decade or two post-war. So that was like, it was just in your model. Like, you didn't have to think about what happens if gas prices change, because gas prices wouldn't really change. And then suddenly they did change. They changed pretty massively. We did run into these pretty hard like geological constraints that we weren't able to find additional oil, and oil, like, there's a depletion curve for these assets. So if you're not finding more oil, you have less and less oil. So suddenly you have a whole different set of assumptions. And it is really, really early to make that call with respect to AI. I've been kind of surprised that there was a fairly muted market reaction. Like, Nvidia's down a little bit, NASDAQ was down a little bit today, but nothing too crazy. NASDAQ was barely down at all. So it's not like the narrative has totally turned, but if at some point we do find that the next models they are an improvement, but maybe not an improvement that justifies the full cost, then a lot of assumptions have to get rethought. Now, there's still a lot of room for growth. Like, we could get many, many years of above average productivity growth out of just getting GPT-4 level models deployed more broadly. There are just a lot of tasks. Like, the way I framed it in the newsletter this morning was, you have a lot of tasks where it breaks down like this. You can do it. Maybe it takes an hour. Claude can do it. Maybe it takes a couple seconds. Or let's say you can do it in 5 minutes. Claude can do it in 5 seconds. But to set up Claude to be able to do that reliably, maybe it takes an hour. You don't exactly know. Maybe it takes a really long time. So every one of those will eventually be something that machine intelligence solves. Like, there are just a lot of thoughts that it's not worth a human being's time to have if you have a good next token predictor that can do that automatically at a far cheaper price. But finding that efficient frontier, that is a long process. And it's actually a longer process in some ways than just researching the next model, because with the model, like, you're solving purely technical problems. It is just, you against whatever forces in this universe conspire to limit the amount of information that we can contain in text, and then limit our ability to build models that predict that text. But when you're actually deploying technology, you also have these social questions of who's using this, why are they using it, what is their incentive, like, to what extent do they actually want to be more productive, versus wanting to do valuable work and worrying that the valuable work that they do can now be automated away. So that's a harder problem. It becomes more of a political problem if AI does start materially taking away jobs. And it's also a problem between companies. Like, you'll have some companies that over-adopt AI, and then they have to sort of have a counter AI strategy of like, we've spent way too much money on this. We have a bunch of really cool toys that are very expensive toys, and we don't actually use them. We have processes that are all built on the assumption that you can't do this, and therefore there's not a good way to slide these into those processes. So it can be a pretty long, there could be a really long path between when we have a technology that saves a lot of time and increases productivity, and when that technology has actually been implemented in the way that saves a lot of productivity. And that's a less bubbly thing, but companies, even though a lot of companies that in 1999, they were telling everyone who would listen about their internet strategy and saying that they were moving everything online, a lot of them talked a lot less about that in, say, 2002, 2003, but they could also look at their metrics and realize that more of their customers are visiting their website, and that more of their competitors are selling online, and that more people have assumptions about what information they should be able to find online, what transactions they should be able to do online. So like that rollout continued even after the excitement died down. And eventually the market sort of re-equilibrated and basically decided, like, a lot of these companies like Amazon, eBay, they are more normal companies than they used to be. Like, they are not massive, revolutionary things, but they do have a model. That model does make sense. A lot of these companies, they've matured, like they have buybacks, they do layoffs. They are kind of a normal member of the S&P 500 in good standing, and not like this new crazy thing where you have to rewrite all the rules. Like Amazon, in some ways, Amazon is like the most normal company imaginable, because they are like an academic corporate finance thought experiment of, what if you had a company where their only strategy was, let's always make sure we can invest at a greater return than our cost of capital. Like, we don't have some specific vision of what kind of company we are, what we do. Like, we sell everything, and we sell everything that consumers buy and everything that business customers buy. As long as we think we have an advantage in selling it, we'll do it. Like, that is what Amazon does. It's not an any particular thing company. It is an everything store. And it turns out that there's just like, there's more store out there than we previously imagined. But they did become more normal. Like, you can model Amazon using the same template that you would use to model General Motors or something. Like, you have different drivers, but they're feeding into the same financial metrics, and you're doing the same kind of discounted cash flow analysis. It's just, when you do it for Amazon, you have a longer period where they're continuing to profitably reinvest. And so you get to a much bigger number when you're calculating what multiple do we slap on current earnings.
Hey everybody, Eric here with a word from our sponsors. Our sponsor for today's episode is Carta, the end-to-end accounting platform that's purpose-built to power the strategic impact of the fund CFO. For the first time ever, private fund operators can now leverage their very own bespoke software that's designed from the ground up to bring their whole portfolio together, enabling formations, transactions, and distributions to flow seamlessly and accurately. The end result? A remarkably fast and precise platform that empowers better strategic decision-making and delivers transformational insights on demand, timely K1s, holistic fund performance data, and so much more. Come see the new standard in private fund management at carta.com/investors. That's carta.com/investors.
Well, another conversation in AI has also been just how far can we get with LLMs, right? In terms of how much do we need more technological breakthroughs to continue the rate of sort of, development these models have been having? And even if there isn't any breakthroughs, how much more sort of business innovation will that lead to, just based on current capabilities alone? These are, I guess, two of the bigger questions I've been having.
Yeah. And I think so. The first big question, like, it's very hard to have a strong opinion. And I'm sure there are people who have strong opinions, but they all, like, the people who have a justified strong opinion on this all work at major AI labs. So they're hopefully not talking too much, not sharing too much material information about their company's secrets and strategy, et cetera. So we'll know that stuff kind of in retrospect, pretty much if we see someone do a really, really expensive training run that gets them a model that costs 5 times as much as the last model and does the same things the last model did. And, you could even imagine a case where they actually run into worse performance from giving it more data, because there is a data cleaning process. Like, you don't want to use everything completely uncritically. And there have been promising cases where model performance in very narrow domains goes up if you have a pretty small model, but it's only trained on the relevant information, doesn't have anything extraneous that would throw off those statistical distributions. So that one is pretty unknowable. Like, I still kind of lean towards scaling laws. Like, my basic view on scaling laws, it's like any other law of nature where it works until it doesn't. And you should probably, like, every time it does work, it raises your probability that the next iteration is going to continue working in the same way. And something like Moore's Law also had to climb this mountain of improbability where if you were looking at the pace of improvement in integrated circuits in, say, the 1970s, it was probably the case that any informed observer could think a couple steps ahead and say, okay, this is the stage where it actually becomes physically impossible. And there was often a case to be made for that. And there is a nice history of very technically sophisticated arguments for why some particular technology bubble is just not going to work. In today's newsletter issue, I also linked to this piece by Bob Metcalfe from 1995 talking about why the internet is overhyped and why 1996 is the year it all falls apart. And what's interesting about that piece is that he does make a lot of valid criticisms, and some of them are actually pretty technical. Like TCP IP was not designed for things that can scale massively. It was not designed to handle big bursts of traffic, and that already was slowing things down a lot and was already just causing some infrastructure problems. But it did turn out that a lot of those were surmountable, and that we did not have to be completely married to technical decisions that make sense at one scale, and then you grow things by a couple orders of magnitude, and some constraint grows faster than that, and things start to break. Like you can redesign some of that stuff to get around those constraints, but you will often find there are just some fundamental barriers. And I have mixed feelings on whether or not the fundamental barrier is just a shortage of really high quality tokens. Because if that is the case, if that is the thing that limits AI models, then anyone who can produce interesting tokens that are not in the training data, suddenly their work is actually valuable for that purpose too. So it is probably a good world for content creators, and that does include programmers. Like anyone who can answer novel questions that have never been asked before and answer them in ways that are outside the training data is suddenly a lot more valuable because their answers could be incorporated into the next set of training data. But it is very hard to know for sure. And it's also really hard to bet against bubbles, even if you do believe that there's a bubble, because they often have these self-reinforcing traits where, like, if you, like, let's say you're an AI skeptic and you're thinking of which companies to short. Well, NVIDIA is partly a proxy for AI, but it's also a proxy for AI hype, because you can have a situation where, let's say, Microsoft and Meta, each of them privately believe that this category is overinvested in, but they also believe that if there is a next generation model that's a material improvement over GPT-4, then whoever ships that first wins a lot of market share, and it's very hard to catch up with them, and it's very hard to raise money to build another model that is either slightly worse, like why would you use it, or slightly better, why would someone switch? So you could have a case where each side thinks the other side's overinvesting, but each side also knows that the other side is overinvesting. They don't realize the other side is overinvesting because they think they're overinvesting. And so they sort of egg each other on, and the result is they both spend a lot of money on NVIDIA. And at that point, NVIDIA wants to spend a lot of money on designing the next round of chips that will be even better and even more efficient. And so when you try to short this bubble, you're shorting it in the face of rapidly improving fundamentals, because the fundamentals that are easiest to track in this case are these purchases of the whatever the limiting input is, which in this case is GPUs for now. Maybe it's electricity in a year or two, or maybe a little bit further in the future. But it means that the bubble economics always look better during the bubble than they turn out to be. And this is actually something that Paul Graham wrote about. He had a really good piece on what the bubble got right. He's reflecting on the fact that he started a little company, sold it to Yahoo. Yahoo's stock went just parabolic for a while and then crashed. But Yahoo, even after the crash, it was actually a viable business. It turned out not to be a great business. They did make a serious strategic misstep by underemphasizing search, but it was a good business and is still part of a viable, profitable business. And what Paul Graham pointed out was that when companies so Yahoo goes public, stock goes way up. And because the stock is up, a lot of people recognize, both founders and investors recognize, that .coms are a viable category, and founders think we should start one, and funders think we should back one. And so they do. And then when that new company is launched, it has to market to some end customer. The customers it markets to are all online. Yahoo is a destination that almost all of these people go to all the time. So where do you run ads? You run ads on Yahoo. So suddenly Yahoo has revenue, and that revenue is growing, and they're profitable. They, for a while, they just, I think, couldn't figure out how to spend money fast enough to outrun their revenue, which is always a fun situation to be in. And so founding a .com startup and getting some money invested in it and then spending that money on ads actually validated the thesis, because it meant that Yahoo was an even more profitable company. So yeah, if you were shorting on the basis of this being unsustainable, you could easily lose many multiples of your money, because the fact that it is unsustainable over long periods does not mean that in any given instant it's going to suddenly reverse.
Isn't another reason why it's so hard to bet against the bubble is that you make the most money right before the bubble pops?
Yeah. I remember at one point in like 2002 and 2003, I was looking at a bunch of just left for dead little microcap tech stocks and looking at their charts. And I realized a lot of them, they actually, like a lot of the lowest quality companies, they kind of bobbed along for a while. And then in Q4 of 1999, they all suddenly took off. And I'm sure every cycle is different, and certainly cycles that happen after academics and practitioners have gotten used to the idea of tracking factors and understanding factor rotation and things like that. Like maybe some of those rules don't apply quite so well. But yeah, I think in a case where you have a theme that's been an investable theme for a while, there are big legitimate companies that are pursuing it. There are pure plays that are bets on this, and some of them are actually quite profitable. Like if you have all of that, and then you start to see the most dubious companies, like companies that used to be weed companies and they changed their name to something .ai, and had a wrapper on some existing AI product or whatever. Like when those companies start rallying, it does at least feel like it's a little later in the cycle. It starts to feel like these are just, it's very unlikely that someone who was unable to build a business running one hype wave, or like riding one hype wave, that they have found there's been like founder hype wave fit. It's more likely that no, these are just companies run by people who like to jump on trends. And when the trend reverses, because they were late to the trend, when the trend reverses, they will be late to figuring that out too. So I do worry a little bit about that, but it's also natural to be salty about it. Like I was short a bunch of these kind of dubious AI plays, and they've been doing really, really well over the last week. So I have reasons to be emotionally invested in that thesis that when the worst companies are rallying, that's when you get really nervous. But it is also true that just as a general heuristic, like people are always trying to figure out when someone makes money in the market, someone is always asking themselves, okay, how can I find the next version of that? And this was a big feature of the 90s. There's this famous incident where Amazon was just one of the hot stocks that you would name when you're just rattling off a list of these amazing .com stocks where they double when they go public, and then they keep on going up, and they're really, really volatile. So Amazon was one of them. And there was this little bookstore chain called Books A Million, and they put out a press release saying they were going to launch a website. And I think the stock went from like $3 a share to $50 over the course of a couple days, and then went right back down. So Books A Million it wasn't going to pivot and become the next Amazon, but it did feel perhaps to some investors like this is the way that you actually catch up, is that if you didn't think of buying the online bookstore, you can at least buy the bookstore that's moving online and maybe get a little bit of that .com magic too. Did not really work that way, but kind of looked that way for a while. And I would note that, in fairness to the point about the timing of this, like Books A Million, I think was 97 or something. So the fact that low quality garbage stocks are rallying because they have tied themselves to some hot trend does not definitively tell you that the trend is overextended, but it does tend to happen more close to the peak.
Is it fair to say that at the time of the internet bubble, there was still some wide skepticism as to whether the internet was going to change everything to the degree that it did, whereas now, even if there is a bubble in some sense of a lot of companies fail or there's just way too much money in it, there seems to be either no doubt or much less of a doubt that AI really is going to change everything. It's just a matter of when as opposed to a matter of if.
Yeah, I don't know how well I'd be able to assess the narrative circa 2000, because it did. The sense I get is that a lot of people did feel like the internet is actually a pretty big deal. There are some industries that will be totally changed by that. We don't know exactly what the timing looks like. And also that a lot of the companies that are trying to do this are just losing lots and lots of money. It is, to some extent, it's really unfortunate that Amazon pioneered this model of we will spend money as fast as the market will let us, because we have internal data on cohorts, and we know that when we acquire customers, they do get just more and more profitable over time. But they didn't really want to disclose that. I think they were very reluctant to tell investors how the model worked under the hood, because the last thing they want is for Target to realize that, to make Target.com a really big site and just crush Amazon and launch Target Prime before Amazon gets the math to work for Amazon Prime, which you can definitely imagine alternate histories where that's exactly how it goes, where some very perceptive person at an existing retailer decides that the Amazon thesis is right and that they have an existing business, so they have cash flow and can invest. Like I'm sure Walmart, I could go back and check, but I wouldn't be surprised if Walmart was just generating more cash flow than Amazon was able to raise over the relevant period. The Amazon's peak investment period, or like peak investment relative to cash flow period in the 90s. So you could imagine an alternate history where someone else catches on and they actually build this before Amazon because they have the existing distribution network, they already have the suppliers, and because they have the distribution network, they can do things like buy online, pick up in store, etc. And just crush someone who's a pure play online retailer who has this big cost disadvantage and also the marketing disadvantage of you drive past Walmart's, you in the 90s did not drive past Amazon's. So like that did give Amazon this incentive to just give investors the high level numbers, kind of give them the story on growth, and then sort of let investors come up with whatever details of that story made sense to them. So as long as Amazon was growing fast and as long as investors accepted the idea that sales will double, losses will double, it's all fine, we'll eventually make money. That did tell a lot of other founders like losing money is totally fine and cool. And I think a lot of them picked up on that part, and they didn't pick up on the whole like losing money now is cool because if you acquire a customer for like 3x dollars and they create 1x in contribution profit each year indefinitely, like they pay for themselves pretty fast. And if that 1x starts growing over time, they pay for themselves even faster, become a really good investment. Like they didn't copy that part. So it's sort of like the whole thing where a lot of founders, it's less common now, but a lot of them just really used to be really obsessed with Steve Jobs, used to try to be as Jobsian as possible. And anyone can copy the part where you only wear one outfit and it's an expensive outfit and you're just really, really rude to people and humiliate them publicly when they mess up. Anyone can copy that. But what's hard to copy is actually having taste and, having a sense of what are the limits that this person could accomplish and how close are they to their absolute limit. That is something that Jobs was uniquely good at, but it's just a more opaque skill to copy. If you like, it always feels like that's what you're doing. If you try to do the whole I'm going to be like Steve Jobs thing, like it always feels like you're pushing people right to their limit. But if they don't actually respect your taste, then when you shred their presentation, they just feel like you're being a jerk and not like they should have done a better job. So I think that general dynamic of there are things that are easy to copy and things that are hard to copy, and the easy to copy things can have multiple causes. And if you copy the effect, but copy it from a different cause, then you're doing something drastically wrong.
Totally. That's a good overview. Maybe segueing to some other topics. We recorded last week's episode before we knew who won the election. Any immediate reactions or reflections as it relates to the election or anything we discussed pertaining to it?
Yeah, so I think in terms of just like the probability sentiment stuff, like I still think coin toss was a really good guess. And a lot of people got it right by saying it's more than a coin toss. And, it takes it takes more than one outcome to know if they actually have a better process or if it was just pretty much close to 50-50 and it was hard to adjust for polling error. Like it could have gone one way, it turned out to go another way. So I have like minor updates in favor of, yes, the Trump Vance campaign was more popular than I had thought, and the polling errors are still in the same direction, etc. But those are slight updates. Like the midterms and 2028 they're still there to make fools of us all. It is interesting to see the vibe shift. It's interesting to see that in the market too, that stocks had a pretty healthy rally. It's like S&P's up 5% in the last week. So that's a pretty positive reaction. And I think some of it is that the first Trump term it de-risks some things where he's going to say a lot of crazy stuff, but he's less likely to actually execute on that stuff. On the other hand, there is more of a mandate this time, and the rhetoric has gotten a bit more extreme. So I think there is still a lot of uncertainty there, and I think there's even uncertainty in just broadly which direction do certain things go. So I wrote a piece last week talking about Elon's hypothetical plan to cut a lot of costs in government, and I just wanted to point out that cutting costs in government, it is good. Government should be more efficient, but one of the macro effects of that is that there is less spending, and so it is somewhat fiscally contractionary. Now, there is a really, really good way to deal with the problem of the government has cut spending and therefore inflation is trending lower than the 2% long-term target, et cetera. Like a classic solution to that is either cut taxes or start giving money away to favored constituents. And either way, people will spend more money. It will kick inflation up a little bit, kick growth up a little bit. So, not exactly a nightmare scenario, but it also kind of depends on what costs are getting cut, because there are a lot of things where, like when you look at overall government spending, the temptation is to look at that and consider just anecdotally how efficient is government and assume that we could get the same goods and services at a much lower cost. But a big chunk of that spending is just transfer payments. So in that case, government, like more efficient government, does mean just smaller social security checks, or Medicare covers less stuff or covers fewer people. So that tends to be pretty politically unpopular. And in fact, Trump has kind of gone in the opposite direction with respect to at least Social Security. So there are probably, I think there could be some cost cuts. Some of that is also dependent on the extent to which Elon saying that he wants to make the government more efficient is like the reason he was supporting Trump, or a reason he was supporting Trump, and actually something he wants to do. It's also possible that when Elon talks about making the government more efficient, it's because he thinks that the fact that Department of Government Efficiency can be abbreviated as DOGE is funny, and that it's just a running joke that has no impact whatsoever. And like in most of the elections of my lifetime before 2016, like you didn't really have to wonder that much if if a particular policy was being proposed in earnest or as a joke. But maybe the fact that government was very, very predictable, very institutional, like you sort of knew that if a Republican gets elected, like they bring in this set of Republicans, they enact this set of policies, and you pretty much know roughly what you're getting. And then when a Democrat gets elected, you have a different set of people enacting a different set of policies. You kind of know what you're getting. There is probably room for there to be some healthy variance in that, and just a little bit more uncertainty. I guess it kind of goes back to the whole like predictable tokens thing of like, if the work that you do is of a similar quality to GPT-4 in some domain, like you were as good at writing the next word of a sentence as GPT-4 is at predicting the next token, then there's a good argument to be made that you shouldn't be doing that. Like you should be doing something a little higher value added, something a little bit more uncertain. You can almost think of, if you do work in different domains, you can try to ask yourself, it's very hard to assess from the outside, but you can try to ask yourself, like, how predictable are these tokens? And it would actually be interesting to do that. Like there are people who they write emails for work, they write essays for fun, and they also do programming for work or for fun. It'd be interesting to have tools that actually look at how surprising are the tokens that you write at each of these different domains to figure out, okay, what is the maximally surprising thing you can do? And if we assume that computers will get better at predicting tokens, you assume that the least surprising tokens you create are the ones that LLMs will be creating for you in not too long. So yeah, if we have a government that is producing lots of extremely surprising tokens, then that is a solution to just stasis and sclerosis. And so there's the judgment call of will we 4 years from now feel like we had too much stasis, or like we didn't have nearly enough stasis? Like we should have actually been in a much more Brezhnevian period because we're worried about the risks from other stuff. So there's a lot that remains to be seen. And we're also in this weird period where Trump can say a lot of things and be very excited about his plans. Those plans have not really made contact with what the House would actually want to do, what the Senate would actually want to do. You have a lot of other countries and just institutions broadly reacting to this in various ways, and we'll see how much that kind of reaction is just like a knee-jerk thing, and how much is actually a longer-term change in their incentives and their framework for thinking about the world. And also, I think another dynamic to keep in mind, like when you look at things like various world leaders talking about how their priorities are changing now that Trump is going to be the next president, one thing that they know is that Trump is just a really vain guy. And I think if he were less vain, he would be far less successful. So it's an attribute that provides leverage, not necessarily good or bad. Like you want a healthy level of ego, but not maximal ego in a lot of different domains. And if he is a kind of vain person, then one thing that it does make sense to do just strategically is to tell him, tell the world that you are just so impressed with Trump that you're going to preemptively do something nice for him. And then if he isn't really thinking of you most of the time, and he does think of you when you say that and doesn't really check a couple months later to see if you actually did whatever you said you would do, then it's a positive expected value decision. And this I think like looking back, Mark Zuckerberg's comments on Trump after he got shot were actually a very elegant way to do this kind of thing, where what he said was it's one of the most badass things he's ever seen and was just really, really impressive and, demonstrated just physical courage, etc. But he didn't say, therefore, I'm endorsing Donald Trump. So he managed to do the thing where he says, Mr. Trump, you're a really, really cool guy, but not the thing where he tells his entire workforce, I'm voting for the Republican this time, and you just have to deal with that. So I think there is probably going to be a lot of that. Like a lot of people are going to be very performatively pro-Trump and maybe privately a little less engaged. And that is probably just the winning move for a lot of people, is to be more vocally excited about this than you actually are, and just kind of see what happens.
Smart people on the left are saying things like, the reasons why they lost are, due to immigration, due to inflation, due to sort of the sort of excess of the 2020 on sort of COVID period on crime, on sort of some of these cultural issues, the defund the police, of course. Do those seem accurate to you, or if it's just a coin flip, it's hard to take lessons either way? If there was a bunch of simulations, unclear how this would play out.
Yeah, I think it does make sense to update in the direction of electorates don't like inflation. And certainly they don't like crime. I think crime is a weird one because its salience is hard to predict because it is mostly a local issue. Like the federal government can put pressure in various ways and can slowly move things in different directions. And certainly the Supreme Court can change things in ways that affect how laws are enforced and how many laws and whether or not they can exist and how they can be enforced, etc. But like a lot of it does depend more on who is the mayor, who is the chief of police, who is the district attorney, etc. So that's stuff where it's really hard to tell how actually engaged people are, and U.S. politics has moved to being more of a national rather than local debate over time. It's kind of hard to figure out exactly why that is. Like some of it is probably this feedback loop where national media, as the marginal cost of distributing content goes down, the benefit of investing a lot in something that's going to have a wide audience goes up. So you have better production values, more entertaining people, et cetera, talking about national issues than local issues. And you have more people who would have been like a local news anchor or local reporter who move to New York, move to DC, and become national influencers instead. And then that means that there's just less attention paid to local politics. It can kind of drift in its own direction. But also, since people are paying more attention to national politics, they sort of want their local problems solved at a national level. And that does mean that, it probably makes crime more salient for presidential elections versus more local stuff. And then, immigration is another one where that has been one of Trump's signature issues for his entire career as a Republican running for president and then becoming president. Like immigration has been a big thing for him. And this is something that maybe Democrats overlooked, but it is a truism that the people like illegal immigrants, to the extent that they are competing with people in the workforce, like they're mostly not competing with native-born, college-educated workers in professional careers. They are mostly competing against less skilled workers, less educated workers, and one big cohort of that is recent legal immigrants. And so that is, I think, one of the big drivers of the Hispanic shift towards Trump, which has been just huge. It's really, really crazy to look at some of the county level swings in very Hispanic counties like along the border. And I think it does get into the question of how people conceive themselves in their relation to like the state and political parties, where if you view your interest group as people of a similar background, then you vote one way. But if you view your interest group as like you're here in the United States, you're trying to get a job, and you're competing with people who are willing to have a much lower standard of living, and they're getting the job and you're not, like you are probably going to vote for someone who tells you that they can solve that problem. So, but I don't think there's anything, I don't think that's like a hugely value added comment for me. I think this is just something where like Republican strategists said, this is how it works. And this is why the numbers, like why polling data indicates that Hispanics are moving, they're less democratic than they used to be. And Democratic strategists kind of said, no, it probably doesn't work that way. They're probably not going to vote that way. And we did find out who was right on that one. But that is like, I think it's also really hard to draw long-term conclusions because Trump is just like a bigger personality than a lot of the people who typically run for president. And a lot of people who run for president, like they they are just really weird people, but they try to tamp that down and kind of normalize themselves and try to be approachable to different audiences. And Trump just doesn't seem to have a lot of interest in that. Like, he doesn't seem to want to be a regular guy, and his constituents don't want him to either. I'm sure that you see some people trying to copy Trump in terms of rhetoric. There is more swearing in political campaigns than there used to be when I was a kid. Like, I remember there was actually a minor scandal in the 2000 election because Bush had a hot mic and referred to a reporter as an asshole. And like, this was in the news for multiple days, that a presidential candidate would privately use a very, very mild swear word to describe someone who was in fact pretty hostile to George W. Bush. So, but now, yeah, those days are past. So that is a case where people are sort of copying Trump. But I think like the right thing to do is look at the base rates and say that the next Republican to run for the next Republican nominee is going to be Trumpier than George W. Bush was, but way less Trumpy than Trump. It is probably not the case that we're going to find someone who, like, they don't have a gold-plated object in their apartment, they've plated everything in platinum or something. We probably will not have someone who's like Trump, only much more so. But that also means that we get really bad data from all these elections. Like, we don't know how much of these results are because of Trump's personal appeal or his personal lack of appeal or his policies or whatever else, because it's all one package. In fact, there was a book, one of the biographies of Bannon a while back did mention that when people were encouraging Trump to run for office in the mid-2010s, one of the reasons for that was that The Apprentice was actually disproportionately popular with Black and Hispanic viewers. And so they felt like he actually had this cross-demographic appeal that many other people just didn't have. And so he could be kind of a nice, neutral centrist. And he did it, like, it did turn out by 2024 that he had some appeal across demographics that Republicans have traditionally had a very hard time appealing to. But yeah, the centrist part did not happen the way people expected. So this is just, it is a fact of life with political predictions in general and political predictions involving Donald Trump in particular.
It's funny. I've in some ways the opposite, or a different prediction, which is I feel like things will only continue to get crazier. And in the same way that we think, Bush is, you're sort of sanguine, you're sort of, homey or something, 20 years later, I wonder if Trump, we'll think of him, 10 years from now or 20 years from now as, remember him fondly. And even people like Andrew Tate might seem more mild in comparison to what's coming. I in my short time on the internet, I've just seen it sort of ratchet towards crazier and crazier. And it's hard for me to imagine it stopping. But we'll see. I mean, it would be a crazy thing if that happened.
Yeah, it's weird. Like the Bush thing it is weird to think of the gap between Bush's perception among like people of my generation when he was president versus those same people's perception of Bush today. Like, there has just been a pretty significant softening of opinion. And I think some of that was that a lot of policies that Bush enacted just kept on rolling through subsequent administrations. I think things were changed a bit on the margin, but like presidents do just, they change things and those things become permanent aspects of the political system. And we just sort of take them for granted. So yeah, there might be something like that with Trump, and like the main reason to think about that is it's very funny to think about it. It's very funny to imagine that, in the year 2050, that we will be able to read op-eds, maybe through a Neuralink implant, that are saying like, Republicans used to nominate these calm centrists like Donald Trump, and whatever happened, like they've gone completely crazy. But I don't know, like not everyone gets that rehabilitation. Like Reagan seems to basically occupy this sort of the same position that he did at the time. Like there are some people who really, really love Reagan. There's some people who are really salty about him. I think there were some concerns like early on in Reagan's tenure that he was just a complete lightweight, totally unprepared for this stuff, and also a crazy right-wing nut job. And I honestly don't know, obviously not reading a lot of the news and not having a lot of political discussions at that time, but like, I don't know how much of that is just that the country did shift rightward on some issues. And so he seemed right wing at the time, and just like more people are Reagan-y now. And how much was that actually people were being really alarmist, and they did not turn out to need to be.
Speaking of sort of rhetoric and sort of messaging, let's close on the going direct sort of topic, because you both wrote this interesting capital gains piece about why the internet didn't immediately lead to sort of, going around the institutions. At the same time, it does feel like, at least in the election, it's like from 60 Minutes to Joe Rogan, like we're seeing a lot of sort of individuals replacing the sort of role that institutions played in terms of being the arbiters of trust. This is the podcast election, et cetera. So why don't you sort of unpack that idea a little bit?
Yeah. So there was this narrative in the 90s that there are a lot of middlemen out there, and they only exist because consumers can't just go directly to whatever product they want to purchase. So something like travel agents would be a classic example of, if you don't have the schedule and you can't easily compare prices and you don't know what the hotels in your destination city are, you might as well call someone up who has all of that information handy. They will solve all of it for you, and you will pay a commission, but maybe they get a decent deal from the companies that they work with. And also, because they have all this data at hand, maybe they can find you a cheap enough plane ticket that it actually offsets the cost of working with a travel agent. So there was this view that if we are all online, if the airlines are all online, they can just put their prices on their website, and we can just go to those airlines directly, do the comparison shopping, and nobody makes a commission. Like you, the customer, are paying the service provider for exactly the service you wanted, and everyone's happy. And then it turns out that actually some of the biggest companies on earth and some of the most valuable companies on earth are very high margin middlemen, where their entire business, like their product is something different, but their business is connecting buyers and sellers and taking a big cut of whatever transaction happens. So that is kind of surprising. And I think there are a couple drivers for that. One of which is that if the cost of aggregating lots of information is lower, and if the cost of finding the right customer is just in secular decline, that's actually an incentive to create more products. There are more things where, like, if there's some product where if 10,000 people buy it, then it's profitable, otherwise it's not. Even if there are 10,000 people who would hypothetically buy it, if the year is 1992, you have no idea how to find those people. Like, you have to get into a lot of catalogs, get on a lot of different store shelves, and maybe you hit half your target market and you paid a bunch of people a big cut and you didn't actually move enough units to make a profit. But if you know that people can find your product online, then there are just a lot more things that are worth creating. And then as soon as there are a lot more things that are worth creating, and as soon as it's also cheaper for, say, an airline to continuously track demand and update prices all the time and do, track individual spending patterns and give people targeted discounts, et cetera. As soon as that's the case, then the search problem has actually gotten harder faster than search has gotten better at solving it. So at that point, you do need some kind of intermediary who can just take this gigantic cacophonous set of offerings that is, the consumer facing part of the US economy, and narrow it down to what are the things you actually want and what is the cheapest way to get them. And then once that exists, once there is some centralized switchboard that connects consumers to producers, then that centralized switchboard is actually creating an enormous amount of value for any given producer. And the more fragmented markets get, the more value there is in providing that connection. So it actually increased demand for middlemen rather than eliminating it. And it did actually produce some really high quality middlemen. Like the user experience of going on booking.com and just finding the exact hotel that you like, the best hotel for you in your destination, getting plane tickets, maybe renting a car, whatever else, like very straightforward, seamless. You don't need to talk to someone. If you happen to want to book your trip at a time when the local travel agent is closed or is out to lunch, whatever, like you can just do it. So like it is a better experience for the end consumer. It's a tougher experience for the seller in some ways, but it also means that seller, they have, I guess, like less granular control over their business, but they do have a dial they can turn for, I want more revenue or less revenue. And if they turn that dial, they're spending more or less on marketing, but they are getting more revenue or less revenue, just in accordance with their preferences. So in some ways it gives them like more fine-grained control over fewer variables rather than like approximate control over a lot more variables. And so in some ways it is just part of the general process of specialization within the economy, where someone like American Airlines, like there's a lot they should know about travel and travel demand and consumer preferences, et cetera. And then there's a lot where it would be useful for them to know it. It's more profitable for Booking.com or Expedia to have that information. So those intermediaries are the ones who will collect the information. They will try to control more of that transaction, and they will they will actually create the overall stack is more profitable in that case because everyone is focusing on the thing they're more specialized in.
That's a great overview. Well, this is perfect. We're at time. This has been a great discussion on all things boom, bubbles, some election recap, and Bern, as always, until next time.
Yes, indeed. All right. Talk to you next time.
Thanks for listening to The Riff. Please go follow and subscribe, give us 5 stars, and check out Bern's excellent newsletter, The Diff, if you haven't already.